If you have 3 lakh rupees right now and want to spend this money on a short-term goal, maybe for example, you're taking a Europe trip next summer, where would you keep these 3 lakh rupees? So in this video, I'm going to run you through 5 investment options for short-term, for example, 6 months, 9 months, or up to 1 year. I'll walk you through the risks involved. I will also walk you through the rewards involved so that you get totally unbiased commentary. If you're new to my channel, don't yet subscribe. Watch this content for the next 7 minutes, and if you learn something new, become a lifelong subscriber of my channel. With that, shall we get this video cracking? Let's go. First investment option is what I call lazy investment option, which is suitable for people who are lazy about their money. Typically, these people have no time whatsoever. Either they're spending their time in their jobs or careers, or they're spending their time in watching Netflix, for example, Manifest, Suits, or Panchayat, or whatever series they like. Therefore, they don't have time and they are not serious about their money. They are very lazy about their money. They leave their money in the savings bank account, and as a result, they get massive, huge 2 to 3% returns on their money every year. And on that 2 to 3%, they also pay income tax as per their slab. So definitely this is an option for people who are lazy about their money and have no time whatsoever. Therefore, they leave their money in the savings bank account. But of course, I don't want to give you any more details about this option. I want to go to option number 2, which is fixed deposits. Fixed deposits are most hated and most boring options on YouTube. But you know what? If you want assured and stable returns, FD is not a bad option at all for 1 year duration. You might get somewhere around 6% returns. For example, SBI at the time of recording this video offering 6.25, ICICI offering around 6.25% returns. So if you're happy with the stable and assured returns, then FD is an option. But the biggest problem with the FD is that if you have to premature withdraw it, your returns drop by almost 2%. For example, if you book an FD with XYZ Bank, for example, ICICI Bank at 6.25% interest rate, and after 180 days, if you have to withdraw this prematurely, then what happens is that you'll get an interest rate of 180 days, which is around 4.5%. And on top, you will have to pay a penalty, which is almost 0.50%. So your return almost dropped from 6.25 to 4%. And that is the big problem with FDs. And of course, tax is another ball game altogether. You have to pay income tax as per your slabs. It's suitable for only those people who want assured, stable returns and are not worried about the quantum of the returns. And the second point about FDs is that if you go for small finance bank FDs, you might get slightly better returns at a slightly higher risk. Third investment option is corporate bonds. In my view, this is for the people who are serious investors. So what are the rewards and the risks in corporate bonds? Let me explain to you with a live example. So for this, I'm heading to Vint Wealth, an online bond platform. So when you go to this platform and scroll down, you will find short-term bonds. For example, let's click on view all and let's have a look at these short-term bonds. What you note here is that there are bonds here which are of the duration, let's say 2 to 7 months, 2 to 14 months, 2 to 17 months. So depending on your short-term goal duration, you can filter out those bonds that fit into that goal. Now for me to explain to you the risk versus rewards, let me quickly take an example. You can pick up any example. I'm going to pick up the first one here, which is UGrow. When you click on it, what you note here is that you are getting 2 options. One is the 2 months investment and 7 months duration, right? Now, hypothetically, if you buy 1 unit of UGrow corporate bonds from Vint Wealth at the time of recording this video on 27th of September, the price is shown as 997.74. That will be your investment. You can buy more units if you want to go for more units. But essentially, if you go for 7 months of bond, your total return will be 1058.95 for the 7 months duration. So you can calculate the annual return. Typically in bond parlance, it is called yield to maturity, which is the net return, which comes out to be 11.25%. Again, I'm not going into the calculations of yield to maturity here, but this is your net returns for the 7 months duration. But this is an annual figure. 11.25 is annual figure here. Now this total return that you see here, 1058.95, you're not going to get it after 7 months. In fact, if you come down here and look at the view more option, you see that every single month you are going to get interest. So for example, 24th of October, 8.34, 24th November, 8.62. And when this bond matures on 24th of April, you are going to get your face value of that bond, which is 1000 rupees. In total, you get 1058.95. These cash flows are fixed on a particular date and time if you continue to hold this particular corporate bond. Now with corporate bond, the flexibility is that you can decide the duration that you want to go for. For example, 2 to 7 months, 2 to 14 months, 2 to 17 months, so on and so forth. Secondly, you can also decide whether you want to go for bonds that are giving giving monthly interest or quarterly. For example, if you come down here, you will see one that is offering quarterly interest for you depending on your cash flow needs. Thirdly, minimum investment amount could be as low as 1000 rupees. So that also gives you a lot of flexibility. Now you may have a question here that Rahul, how do I go about selecting the corporate bonds? So on my channel, I have created 2 videos, and if you go and watch these 2 videos, you will get a lot of in-depth insights about what are the factors that may decide your buying behavior when it comes to corporate bonds. Please go and watch those videos. I'm not going to repeat it here, and that will exactly tell you my position in terms of how do I go about corporate bonds. You can learn from others as well, but essentially if you watch those 2 videos, you're going to get ton of knowledge. Now this is all about the flexibility and the reward sides of the corporate bond. Let me now speak about the risk associated with the corporate bond. So when it comes to the risk, the biggest risk in corporate bonds is something called as default risk. Hypothetically, for example, the NBFC or the corporate bond issuer that you're buying the bonds from, let us say if that company goes bust or goes bankrupt, now what happens to your principal and your interest? It gets stuck. This is called default risk in the corporate bonds. Now what are the chances of this happening? Now for this, let's have a look at some past data. What you see is this FY25 report published by India Rating and Research, and they have published the cumulative default rates, CDRs. So for example, the bonds that are rated highly, which is the AAA rating, in the last 1 year, last 2 year, last 3 years, weighted average of default is 0%. If you look at AA rating, the default rate in the last 1 year is 0%, 2 years is 0.1, 3 years is 0.1, which is a very, very low default rate. But yes, defaults do happen. And if you look at A rating, the default rate slightly goes up. In 1 year basis 0.2, last 2 years 0.7, last 3 years 1.4. Point is that credit rating seems to have a direct linkage with the default rate. Again, this is not a guaranteed correlation, but this is what the data is telling us. Now you may say that, Rahul, in that case, it's better to go with AAA. Well, it is an individual's decision. Why? For example, if I show you the correlation between the credit rating and the coupon rate or your returns that you're going to generate from bonds, that entirely depends on the credit rating. This is because the returns that you're going to generate from corporate bonds also depend on the credit rating. For example, AAA, typically the coupon rate is 7 to 8%. AA, typically it will give you 8 to 9.5%. A credit rating will offer you something like 9.5 to 11.5%. Point is very, very simple. Depending on your risk appetite, you can decide whether you want to go with AAA, AA or A, because the returns as well as the risk lies in the credit rating of the corporate bond. Now there are various online bond platforms that you can go and select these corporate bonds from. Personally, I like Wind Wealth, mainly because they invest 2% in the bonds that they get listed on the Wind platform. So that gives me a lot of confidence. And that's why I'm also an investor in Wind Wealth. So as I said in the beginning, corporate bonds are for serious investors who are willing to take slightly more risk. With that, let me now move to option number 4, which is liquid funds. Liquid mutual funds, in my view, are for savvy investors. Let me give you live examples of liquid mutual funds so that we understand the risks versus rewards. For this, I'm heading to the Coin app by Zerodha. That's what I use. So I'm showing you using examples. Now, if you start typing liquid here, what you will see is bunch of liquid mutual funds coming. And again, let's pick any of them for example purposes. None of these are recommendations. So I'm going to click on, let's say, SBI liquid mutual fund. And when you click on it, you are going to see 1 year return, 2 year return, 3 year return. So last 1 year, it has created 6.82% returns. If you look at the last 2 years returns, it has given 7.12%. If you look at the last 3 years, 7.04. Point is simple, that somewhere between 6 to 7% returns is what historically this one has generated. What about others? So if I go back and again type liquid mutual funds here, let's go to the next one, which is the HDFC liquid mutual fund, and click on it. Let's have a look at the last 1 year, 2 year, 3 year return. Last 1 year 6.88%, last 2 years 7.14, last 3 years 7.06%. What do you note here? The difference between AMCs in terms of the returns is going to be very, very minor here. And I'll tell you the reason for that in a minute, because of the underlying instruments that liquid mutual funds park their money in. But more importantly, liquid mutual funds returns vary depending on the ongoing or the prevailing debt rates in the market. Primarily the RBI repo rate. If the RBI repo rate is on the higher side, you would see liquid mutual funds doing better returns. But if you see RBI repo rate going to the lower levels, then liquid mutual funds are going to give you slightly lower returns. But mota, if you look at it, 6 to 7% in the last 2 to 3 years is what they have given. Again, past returns do not guarantee the future returns, but you're not going to make huge returns here, 8 to 10%. The objective here is not the returns. The objective here is the safety and liquidity. Let me speak about that. So for example, if you go to MFI's website and you read about liquid mutual funds, what is written here very clearly is that liquid mutual funds are for optimum returns while maintaining safety and liquidity. Important point, please do not go for returns when you are investing your money in liquid mutual funds. Here, the primary objective is to optimize your return. Of course, you want to optimize your returns, but you want to make sure you are safer and there is a liquidity for your investment. Now, why are liquid mutual funds relatively safer debt mutual fund? Because, for example, have a look at Axis Mutual Fund. Again, just an example here. Where do they invest? They invest in certificate of deposit, commercial paper, treasury bills, and these are debt instruments. The chances of defaults are very, very low here. And more importantly, liquid mutual fund invests in those commercial paper or those certificate of deposits which mature within 91 days. Therefore, the default possibility comes down because they are not long-term instruments. They are short-term instruments. And also the fluctuations in the debt rates is slightly lower here. Why? Because the instrument is only for 91 days and therefore the fluctuations are relatively lower, gives you stable returns, safer returns. Again, nothing is guaranteed here, but safer returns as compared to many other debt mutual funds. Now comes the second aspect of liquid mutual funds, which is the liquidity. Now, these liquid mutual funds you can redeem within 1 working day, which is very, very quick. And in fact, if you want even faster redemptions, you can consider liquid ETFs. They work exactly like liquid mutual funds, but they're listed on stock exchange. For example, if you go to your Demat account, let's say Zerodha's liquid case is there. Again, this is just an example. You can simply go buy and sell it during the market hours. What happens due to that is that you are able to quickly redeem your money should you need your money. So therefore, liquid ETFs provide you that liquidity. Now, from a returns perspective, there might be slight difference between liquid ETFs and liquid mutual funds. Which one is better? It really depends on your need. If you are an active investor, very easy to navigate through the exchange in terms of buying and selling, liquid ETFs are good options. If you don't want to get into that, you can simply buy them using the liquid mutual funds because there you will have to wait for 1 working day to get your money redeemed. Now, another option within liquid mutual funds that you get is that you get growth liquid mutual funds and you get IDCW liquid mutual fund. For example, here, if you see SBI liquid fund has got growth option as well as IDCW. What is growth? Growth is simply that you invest in this particular liquid mutual fund, and when you redeem your liquid mutual fund, you get all your money back, which is your capital, and whatever gain the liquid mutual fund would have generated. But in case of IDCW, for example, here it says fortnightly, meaning that on a fortnight frequency basis, you will be able to get some money, which is your capital, and whatever gain that would have been made by that liquid mutual fund. So if you want cash flow during the next 6 months, 8 months, 9 months, 1 year, whatever period, then IDCW is that option. But if you don't want the cash flow, if you just want to park your money and get your money when your short-term goal is met, in that case, growth is the option to go for. Now comes my last point. How do you go about selecting the liquid mutual funds? I had created this video. Please go and watch this video. Step by step, I have talked about my method that I use for selecting and filtering out the liquid mutual funds. Hopefully, if you watch that video, you are going to gain a ton of knowledge and it can become very, very easy for you to navigate through the world of liquid mutual funds. With this, let's move to investment option number 5. And before I talk about investment option number 5, so far if you're liking this video, request you to hit the like button. Let me know in the comments a simple thank you. You can subscribe to my channel. And also if you want to get exclusive content, you can consider joining my YouTube community. I speak about various assets including mutual funds, stocks, ETFs, etc. almost on a daily basis. The feedback of this community has been very good. I bring a lot of market insight so that you become a better long-term investor. You can simply go to my channel, click on join button and be my guest. With that, let's start talking about investment option number 5, which is arbitrage mutual fund. These mutual funds are suitable for people who are in higher income tax slab, for example 30% or more than 20%. Why? Because of the taxation benefit. I'll speak about that in a minute, but let me first show you arbitrage mutual fund live example. So if you go to Coin app or any other app that you use, I'm going to simply type arbitrage mutual fund here and you'll see bunch of mutual funds coming down. Let me click on the first one, which is Kotak Arbitrage Mutual Fund, so that we can have a look at the returns in the last few years. For example, last 1 year, this fund has generated 7.38% returns. Last 2 years, 7.90%. Last 3 years, 7.83%. Again, these are slightly better returns than liquid mutual funds, but these are not guaranteed returns. Past returns do not guarantee the future returns. We need to understand why arbitrage mutual funds are able to generate slightly better returns than the liquid mutual fund. I'll come to that in a minute, but let me also show you a couple of other examples. So let's go to arbitrage mutual fund again, and let's go to SBI Arbitrage Opportunity Fund here. Again, not a recommendation. These are some examples. Last 1 year, 7.32%. Last 2 years, 7.69%. Last 3 years, 7.72%. Very, very similar return profile you would find across the AMCs. Now comes the most important point. Arbitrage mutual funds, why are they tax conducive? The point is that arbitrage mutual funds invest at least 65% of their portfolio in equities. Again, I'll show you live examples of that. And therefore, their short-term capital gain tax, which is if you hold them for up to 12 months, that tax is 20%. Now, if you fall under a tax bracket of, let's say, 30%, then this is going to save you tax. But if you fall under a tax bracket of, let's say, 10%, then don't go for arbitrage mutual fund. Why? Because short-term capital gain tax here is 20%. You will end up paying more tax, right? But when it comes to long-term capital gain tax, if you hold them for longer than 1 year, you are going to pay 12.5% capital gain tax. Again, if you are falling under 30% tax bracket, then here you are paying only 12.5%. If you're falling under 20% tax bracket, then 12.5% is slightly better than 20%. But if you're falling under, let's say, 10% income tax bracket, then arbitrage mutual funds are not for you. It's only for those people where they are paying 20% to 30% of income tax because of whatever reasons. Now, how does arbitrage mutual funds actually work? Very, very simple example. You buy a stock of a company, let's say from the cash market, like you and me go and invest in stock market. You go and buy it from the cash market. Let's say you buy it at 500 rupees. This is an example here given very clearly, but you sell the same stock in the futures market, right? And if you're able to sell it at, let's say, 512, then what you have done here is that you have gained 12 rupees of arbitrage. It is called arbitrage at the time of expiry. You can realize these gains or not depending on the mutual fund manager's strategy, but essentially one asset you are transacting in two different markets and you are trying to take advantage of the price difference in these two markets. And that's how you essentially make money. And the second part is that when these opportunities do not exist in the market, what simply happens is that these arbitrage mutual funds end up parking the money in the debt mutual funds, right? So that's how they basically invest the money and give you those gains that they generate because of the arbitrage. Now, whether arbitrage mutual funds can generate higher returns or lower returns, it depends on a couple of factors. I was reading this report from Kotak Arbitrage Fund, and what they were talking about is that if for whatever reason F&O segment activities go up, then arbitrage mutual funds are likely to generate slightly better returns. Secondly, if the volatility in the market is high, then what happens is that arbitrage opportunities open up and therefore arbitrage mutual funds are likely to generate slightly better returns. Again, nobody can promise these things, but these are some of the drivers that you need to understand. Now, let me quickly show you live example of one of the arbitrage mutual funds so that you understand it very, very practically. I'm taking an example of SBI mutual fund here, and what you note here is that, for example, first stock here, HDFC Bank, they're holding this particular stock in the cash market. Quantity is 2 crores 61 lakh 16,200 quantity. Now what they've done is they've done the reverse in the futures market. Let me show you. If I just come down here, scroll down and show you the positions in the derivative market. So if I just come down here and show you exactly the same stock in the derivative market, they have got a short position here and they've got 2 crores 61 lakh 16,200 quantity. So the gain from the cash market and the loss from the future market is going to offset, and in this arbitrage they are likely to make some money. That's how the arbitrage mutual funds go about investing their money. And also they have the debt component. So if I show you, for example, if I come up here, you see here that they have also invested in mutual funds here. For example, 14% of their exposure as of now in the month of August 2025 is in the mutual funds. They also have treasury bills a little bit. They also have certificate of deposits 5.5% here, and they also have commercial papers 4.71%. So these are hybrid mutual funds. They invest in equity and take advantage of the arbitrage. They also invest in debt instruments. Because of the equity allocation which is has to be 65% at least, they get the tax treatment of equity, which is 12.5% long-term capital gain and 20% short-term capital gain. And if you fall under 30% tax bracket or more than 20% tax bracket, then arbitrage mutual funds can save you tax. So in this video, I've talked about 5 investment options for short-term duration. Which one is your favorite? Let me know in the comments. Also, let me know in the comments any other short-term investment option that you like personally. I might create further videos detailing out those options as well for greater awareness. I hope you liked this video. If you did, press the like button. I'm going to see you in my next video. Until then, keep rocking.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.